Welcome back to Entrepreneurial Edge. Today we're breaking down exactly who gets hit hardest in a recession, and how you can avoid being one of them. Let's dive in and learn how to build a financial fortress that weathers any storm. First up, let's talk about the overspenders. These are the people who just can't resist the allure of the finer things in life, always reaching for the next luxury purchase, whether it's the latest fashion, gadgets, or high-end experiences. Every time they get a pay raise, their lifestyle inflates right along with it. Instead of saving or investing, they upgrade their car, phone, or home, living paycheck to paycheck, just at a higher, more expensive level. But when a recession or financial emergency hits, those luxury payments don't go away. Instead, they become heavy anchors, dragging them down and making it even harder to stay afloat. Suddenly, all those status symbols, designer bags, fancy cars, upscale homes, turn into liabilities that are tough to maintain or sell. The lesson here is simple but powerful. Always spend less than you earn, no matter how much you make. By creating a gap between your income and your expenses, you build a safety net that protects you when times get tough. In the end, living modestly and within your means will always beat the stress and risk of flashy debt, especially when life throws you a curveball. Next, let's talk about the emotional decision makers, often called panic sellers. These investors have money in the market, but when prices start to fall, fear and anxiety quickly take over. Instead of staying calm, they react emotionally and rush to sell their investments, often at the worst possible moment, right when the market is at its lowest. By selling in a panic, they lock in their losses and miss out on the eventual recovery when the market bounces back. This means they not only lose money but also miss the opportunity to benefit from future growth. The key to avoiding this trap is to stick to your long-term investment plan, even when things look scary in the short term. Remember, investing is a marathon, not a sprint. The market's ups and downs are just noise if you're focused on your long-term goals. Over time, markets tend to recover and grow, rewarding those who stay patient. True wealth is built by staying the course, tuning out the headlines and trusting your strategy, not by reacting to every dip or piece of bad news. Then there are the risk takers, those who go all in on the latest hype, from crypto to penny stocks. When the economy turns, these speculative bets are the first to collapse. Diversify your investments and keep cash on hand. Don't gamble your future on a single unproven asset. Managing risk beats chasing quick wins every time. The reckless borrowers rely heavily on debt to fund their everyday lifestyle, maxed out credit cards, personal loans, and a constant cycle of borrowing just to keep up with expenses. They often ignore the growing balances, thinking they'll pay it off later, but the debt keeps piling up. Tempted by buy now, pay later offers everywhere, they make purchases without considering the long-term consequences, adding to their financial burden with every click and swipe. When interest rates rise or income unexpectedly drops, what once seemed manageable quickly becomes a financial trap, making it harder and harder to escape the cycle of debt. Missed payments not only destroy your credit score but also limit your future options, making it difficult to qualify for loans or even rent a home. The best way out is to pay down high-interest debt aggressively. Focus on the most expensive balances first, and make consistent payments to reduce what you owe. Only borrow what you can truly handle, even if your income takes a hit. Careful budgeting and understanding your limits are key to staying afloat. In a recession, having less debt means more freedom, less stress, and the ability to focus on what really matters, your future and your peace of mind. Overspecialized workers thrive in good times, but if their niche dries up, they're left stranded. Build a broad, flexible skill set. Be a T-shaped professional, deep in one area but adaptable across many. The ability to pivot is more valuable than any single specialty. Adaptability is your best insurance in a changing economy. Underprepared savers think a small emergency fund is enough. But a recession can last far longer than 3 months. Once that cushion is gone, desperation sets in. Debt, selling investments, or raiding retirement accounts. Aim for 6 to 12 months of expenses in your emergency fund. True security comes from robust preparation, not just a little savings. Asset-rich, cash-poor people look wealthy on paper, homes, businesses, collectibles, but have little liquid cash. When income dries up, they're forced to sell assets at a loss just to pay bills. Maintain liquidity. Cash is king when times get tough. Liquidity gives you options and power when others are desperate. The survivors thrive in recessions. They live below their means, have a solid emergency fund, minimal debt, and diversified investments. They don't panic. They see downturns as opportunities. Multiple income streams and disciplined habits set them apart. Wealth is built on preparation, not luck. Recessions expose financial weaknesses, but they don't have to wipe you out. Preparation, living below your means, saving, diversifying, and managing emotions is what matters. You can't predict the next downturn, but you can be ready for it. Thanks for watching Entrepreneurial Edge. Subscribe for more strategies to build lasting wealth.